Okay, we get, if we include bonds, everybody's holding some combination of M and bonds. M must be the market if everybody's holding it, because demand equals supply requires that. And then once we've got this aggregate risk-return trade-off, the capital market line, we can show that everything must fall in the same risk-return relationship. Otherwise, you'd have these deviations, these arbitrages. Okay, any questions about any of that? So if you'd figured that out 50 years ago, what would you have today? Anybody know what the people who figured this out got? They got Nobel Prizes. Okay? So we've gone through it in a lecture. You got a Nobel Prize for that. Okay? Now why? Well, it revolutionized the way people did finance, because now you could quantify risk. You can actually go out and measure the beta for a stock. You can use that to make investment decisions. It's an extremely useful concept in corporate finance. And so we're able to make much better allocation decisions, much better risk decisions, and so on. So it really did change things drastically. Now, it was not so easy at the beginning. So the person that figured out that we should start thinking about things in terms of this diagram, this mean standard deviation diagram, does anybody know what his name was or is? His name's Harry Markowitz. Now, he was a PhD student at the University of Chicago in the late 40s, early 50s. And he wrote this thesis. And his thesis is, this is the way we should think about risk. We should think about stocks in terms of their mean and their standard deviation. And once we've done that, we can work out the optimal portfolio. And it's a much more sensible way of thinking about risk than we've got so far. Now, when he went to defend his PhD, one of the people on his committee was the famous economist Milton Friedman. Now, with a PhD, what you do is have an oral exam. So he shows up for the oral exam, and Milton Friedman gives him a very hard time. What are you doing here? Explain it to me. Why did you get this result? So it's a very tough exam. So then he leaves, and then the committee discusses. And Milton Friedman says, this isn't economics, it's just statistics. We should fail the guy. So the other people are going, well, but it's a bit different, it's kind of interesting, quite novel. Milton Friedman's going, no, it's rubbish. So anyway, in the end, they prevailed, and Harry Markowitz got his PhD. Now, he wasn't too thrilled with academia, since he'd almost been sent home, having spent 4 or 5 years of his life working on this. And so he went off and he worked for IBM and went into industry. And then, of course, in the early 90s, he was awarded the Nobel Prize. So one of the journalists had heard this story, so he went to Milton Friedman, said, so what do you think about Harry Markowitz winning the Nobel Prize? And Milton Friedman goes, he shouldn't have got his PhD, he certainly shouldn't have got a Nobel Prize. But I think Harry Markowitz had the last laugh on that one. So, very well deserved. He got it. Now, it took people 10 years to figure out that you could make this huge leap forward if you put in government bonds and drew in this line, and that must be the market. And there are two people that figured that out. One is Bill Sharp, who's a professor at Stanford, and the other was John Lindner, who was a professor at Harvard. Unfortunately, he died. And one of the things you have to do to be eligible for a Nobel Prize is to be alive. So Bill Sharp got it. Now, I think they're very well deserved, and everybody would agree that this was an extremely important step forward, because it was not only important the way we think about the world, it's very important in the way that we evaluate investments, we evaluate risk, and so on. Before that, people would say, okay, well, if it's got higher risk, it must be higher return. But there was no notion of what that relationship was. How did you even think about risk? People weren't quite sure whether it was standard deviation or what it was. And that's why what these guys did was so very important. Now, the other person who got the Nobel Prize this year in the 90s, when Markowitz and Sharp did, was somebody called Merton Miller. Now, we'll see what he did later on in the course, but he also made some breakthroughs which revolutionized the way we think about the world. And so these are very simple ideas. It doesn't take that long to get the CAPM, but they're extraordinarily powerful and very important for how we think about doing business, because fundamental to business is risk, and this is at least one sensible way to start thinking about risk. Any questions or comments? Okay, have a wonderful weekend, and I'll see you on Tuesday.